What was your first ever investment? Mine was a savings account and a fixed deposit. And I'm pretty sure that was the case for most of you. Today, I'm going to discuss how you can save tax using a fixed deposit and a savings account. Before we start though, if you're new to our channel, please consider subscribing to get notified whenever we upload a new investment related video. So let's get started. If you have a savings account, you pay tax on interest you receive. However, if you are younger than 60 years, you can claim deduction of up to Rs 10,000 on interest received in your savings account under Section 80 TTA of IT Act. All you have to do is to claim this deduction in your IT return. If you are older than 60 years, you can claim deduction of up to Rs 50,000 on interest received in your savings account and on fixed deposit under Section 80 TTB of IT Act. This provision was specifically designed to cater the tax saving needs of senior citizens who prefer FDs over other investment options. All you have to do to claim this deduction is to claim it in your IT returns. Now let's talk about tax saving FD. Tax saving FDs are one of the approved investment options under Section 80C, using which you can claim deduction of up to Rs 1,50,000 on your taxable income. If you would like to know about all the investment options eligible for tax deduction under Section 80C, please check our previous video, whose link is right here and also in the description below. Tax saving FDs are fundamentally similar to regular FD, but there are few key differences. So let's discuss them. The first fundamental difference between a tax saving FD and a regular FD is the lock-in period. For a regular FD, the lock-in period can be as low as 7 days, but for a tax saving FD, it is 5 years. The other key difference between a tax saving FD and a regular FD is the restriction on the maximum amount that you can invest. For a tax saving FD, the maximum you can invest is Rs 1,50,000, which is same as the deduction that you can claim for these FDs. However, for a regular FD, there is no such restriction. There are few other key differences between a tax saving FD and a regular FD. You can take loan against a regular FD, which is not possible in case of a tax saving FD. Also, early withdrawal is possible in case of regular FD. However, there is no provision of early withdrawal in case of tax saving FD. You can invest in these FDs through any private or public banks except cooperative or rural banks. You need to provide your PAN details while applying for tax saving FDs, as these details are printed on certificate of your FDs. Investment in post office time deposit of 5 years also qualify for tax deduction of up to Rs 1,50,000 under Section 80C of IT Act. Here are a few things that you should know about tax saving FDs. Number 1. The returns that you get from these FDs are completely taxable and TDS is deducted from the interest that you receive. Number 2. You can add nominee to a tax saving FD just like a regular FD. Number 3. Resident Indians, NRIs and HUFs all can invest in tax saving FD. Number 4. Senior citizens often receive higher interest rate for these FDs, just as in case of regular FD. If you like this video, smash that like button and share the video with your friends and family. Also, don't forget to leave your feedback in the comment section below. Thank you.